Hi, I'm Jeanette Delgado with JD Management Advisory. I'm here today with Bill Thompson. Bill is a CPA, and he's here today to talk to me a little bit about a different option for physician owners that are looking to expand their portfolios in terms of their wealth and legacy. And so we are going to talk today a little bit about real estate and how that could be an option. Just a quick note, this is just an educational video. This is not a tax advice. This is not investment advice. This is strictly a conversation to give some of our physician owners some ideas about how to expand their business or how to expand on their wealth or their retirement. And certainly this can be applied to any other business, but we are focusing on the physician owners, which is a specialty of mine. So I wanted to bring Bill on board to kind of give us a different perspective. Welcome, Bill. I'm glad that you're here today.
Thank you. I appreciate the opportunity to discuss this issue in front of your audience.
Bill, tell me, what is the name of your business?
The name of the business is BRRRR Accounting and Tax Professionals.
And if somebody wants to reach out to you, what is the best way to reach out? Do you have a web address that they can go to or visit?
Yeah. Yes, at the conclusion of this, I'd be happy to drop the my website into the chat so folks could access that should they have the desire.
Perfect.
Absolutely.
So, like I said, Bill is unique in this perspective and in this conversation because he's not only a CPA, he has for many, many years practiced as a CFO, which has helped a lot of businesses grow and really have a good understanding of their financial standing. And also he has developed and created a really robust portfolio of his own in real estate. So can you explain to us a little bit how you got into all of these different areas? How do they intertwine? What got you interested in all of these areas, and give us a little bit of the background.
Okay, my interest in the accounting field began at a very young age. I was a young worker at a South Jersey, in a South Jersey shore town, and I worked for an employer who owned a motel. And basically I was the pool boy, the cleanup guy, things of that nature. But what got me interested in accounting and tax was the fact that the employer promised me X amount of dollars per hour, and I knew how many hours per week I was going to work. So after my first week there, I look at my paycheck and I compare it to the hours that I work and what he said he was going to pay me, and I noticed there was a difference, a noticeable difference. And I went home to ask my father. I said, why would he pay me a different amount than what he told me? He said, no, son, welcome to the real world. He actually did pay you the correct amount, but he, as the employer, has to legally withhold income taxes for you so that the federal government and state government can run their programs that they have for the folks in the United States and the state of New Jersey. And from that point on, I just felt that there's got to be something we can do to reduce these taxes or maybe even get rid of them. So with that said, I began my college career, majored in accounting. Once I graduated, I got my CPA, and I realized that one of the avenues that I could potentially reduce my taxes was through the ownership of real estate. And how I found that out, as I mentioned, I lived in a shore town. A couple of my friends' parents, one owned a motel, and a couple other of them owned boarding houses. And I've always, in conversation, in passing, heard them talk about how they could reduce their tax burden by investing in real estate. Now, of course, that was prior to the 1986 Tax Reform Act, which back then, unlike today, it was like the Wild Wild West. You could make a large purchase, take depreciation on it, and wipe out a lot of W-2 income. But again, that's changed. But there's still opportunities in real estate. So I wanted to focus my mind on staying or getting into the real estate game. But what I realized real quick was that you really needed to have some sort of capital to get into the game. I mean, there were a lot of books out there back in the day that said, oh, you can buy real estate with no money down, this and that. That can be true, like with some seller financing, but in general, that's a hard avenue to go down. So once I graduated, got my CPA, I went on to become a staff accountant in a company, and I had worked my way up to CFO. And I used that W-2 CFO job to start squirreling away some money so I could begin to purchase real estate. I was going to use that as one of the avenues to get into the game. And I was still self-educating myself by, reading books and things of that nature. And I was reading a book, and the author was discussing how to use the equity in your primary residence to purchase a piece of real estate. So I got very interested in that, continued to read on it, and that was actually how I purchased my first property. And I utilized one of the strategies they call today, I don't know if they called it back then, but it was called the BRRRR method. It's buy, rehab, refinance, rent, repeat. And that's kind of how I did it. So I was able to, during that time, my primary residence had a boatload of equity in it. And if anybody knows anything about equity, it's a nice thing to say you have equity, but if you're not putting it to work for you, it doesn't really mean anything. So I actually put the equity in my property to work for me. So I bought my first piece of real estate, and I bought a property that needed to be fixed up, i.e. the BRRRR method. So I took out cash from my primary residence, bought the property, rehabbed it, and then once I rehabbed it, I got a tenant in there, and then I refinanced it. And back then, I believe it was like 80% to loan value you could get. So I took the 80%, took a mortgage, a primary mortgage out on the rental property, and lo and behold, it paid all of my money back that I took out of my home equity, and I actually put $8,800 in my pocket. Mm-hmm. And top it off, that rental was giving me $350 a month positive cash flow after all my operating expenses and my debt service. That was a really nice gig. So if you figure that out, the way you can way depreciation set up, you can write off and maybe even create a loss, but you can definitely reduce that taxable income for renting the property down to zero. So in effect, each month that $350 cash flow can go into your pocket without any tax consequences. So I thought, wow, that's a powerful, powerful thing. I thought to myself, what happens if I were to get 10 properties? Could I do that same thing? And yes, it is done right. You can absolutely do that. And I'm a prime example of that because, as I mentioned, I started into the real estate game in 2001. And by 2020, I had built my portfolio to 48 individual properties.
Wow. Yeah, that's... That's
yeah,
fantastic.
And as you mentioned, the unique thing with me is I have the CPA and the CFO. The CPA really helped me hone in on the tax consequences, how to legally avoid paying taxes. But my CFO position actually gave me the focus to, hey, this is a business. We got to run this as a business. So I put standard operating procedures into place. So I set it up from a CPA perspective as well as a CFO perspective. And to date, it has really, really helped me immensely. I mean, I put both of my kids through college, coming out with no debt. So, and that, by the way, that was the goal for me. I only wanted to get 3 or 4, maybe 5 properties, so I didn't have to tap into my W-2 income to pay for their college education. Yeah. And it went far beyond my expectations. I paid for their private elementary and high school and then college, and didn't have to touch any of my retirement assets or any of my CFO jobs. So yeah, that I believe that uniquely qualifies me to speak on these topics. So I'm happy to do that for you today.
Well, that's very interesting because although the physicians obviously are not in your industry, but they have a similar path in life. You know, they have their private practice, but they too can kind of then build upon that based on what you're saying. So, and the fact that, you know, you were able to do all these things for your children and by using this strategy kind of goes into most physicians' sort of purpose, because they really want to leave a legacy. You know, there are certain goals in their life. For most of them go into private practice, because they want the control over their business, so they need to understand how to run the business well. But they also want to leave a legacy, whatever that might look like for their children. And they also want to be able to, you know, probably mentor or build, you know, upon maybe helping other people within the, you know, the medical industry, within their practice. You know, a lot of physicians bring in young physicians and they like to mentor them, or even, you know, some PAs or things like that. So it sounds like this is something that really can allow them to do and really meet those goals that most physicians have when they go into private practice. So this is fantastic information, and I think it's really important. And so it also, you mentioned being the CFO and understanding the business aspects of it. So what would you, as a CPA and as a CFO, sort of advise them as they're building their private practices and thinking about, you know, going into maybe the real estate component of building their wealth? What is it that they need to do to go into this mindset, this thought process? Because as a bookkeeper for a lot of physicians, I understand what's going on in the medical practices. You know, they're struggling to make ends meet because, as you know, the medical insurance reimbursement, things like that, and in some states is very difficult. Sometimes they're not even meeting their costs, and so I try to help them, you know, optimize their profitability, you know, through bookkeeping strategies. But as a CFO and as a accountant, CPA, what are key points that they should think about as they're building their practice with the goal of maybe investing in real estate, or going into, you know, maybe investing in 401ks or other retirement plans? But putting that hat on, what kind of advice can you give them? What kind of, maybe give them 2 or 3 points that they could think about as they're building to invest in this real estate component of their legacy?
Yeah, sure, I can absolutely do that for you. But I want to do that through an example, if that's okay with you. All right, I deal with a lot of physicians for tax planning and real estate, but in particular, one physician that I just brought on as an advisory. I met with him and his wife. I'm going to make sure I'm saying this right. She is a moles surgeon, which it has to do. Yep. So their W-2 is borderlining on the 37% tax bracket, which means it's over $750,000.
Yeah.
Okay. So the first thing I sat with them, because they approached me, they got referred to me. They approached me and said, "Look, we really need to put together a strategy so we can reduce the W-2 income." I said, "Yep, that's exactly what I do for folks." So I said, first and foremost, and I say this with all my clients, if they're married, I said, you have to have buy-in from both partners, because this is going to be a business and you have to focus and think like it's a business. So I cannot have one of the partners wishy-washy or, you know, not 100% sure, because there are a lot of people, even physicians who are well educated, tend to get a little bit nervous when they say to get into real estate, because we're talking large numbers. So the number one thing I do is I want to make sure that they have buy-in. Once they have buy-in, then I can start setting the strategies for them. Now with this couple here, As I mentioned, she was a mold surgeon, and he was a computer tech, not technician, like a network engineer. He was knocking down about 175, but she was going to be at the 750 level. So I said, all right, it's going to be very difficult for you folks to be able to reduce your income with just coming up with miscellaneous deductions. I said, you guys need to make a commitment here to make this work. And I said, there are a few strategies, and one in particular that I want to put out to you and tell you how it operates to see if I can get buy-in from you. So the strategy, one thing we should know is there are two types of income: non-passive income and passive income. W-2 income is non-passive. Rental income is passive. The two never meet, meaning if you have positive income from your W-2 job and you're showing a loss on this property, you can't reduce your loss, your W-2 by that loss, unless you meet a couple of thresholds. Now, the threshold that I'm recommending, and I'm actually in the process of putting a plan together for them, the strategy that I'm going to recommend to them is called real estate professional status. Now, what that means is the spouse that's earning the lower amount of income needs to make a decision to maybe get out of their W-2 so that they can qualify for real estate professional status. Now, what does that real estate professional status? The first thing is you have to work 750 hours or more in a real property trade or business. A couple examples of a real property trade and business are rental real estate, broker, sales agent, property manager, or in the construction. So when you do that, when you get the 750 hours, you now have what you call real estate professional status. But you're not there yet. You're not there yet. You have to materially participate in your rental business. And there are seven standards that you need to meet in order to qualify for material participation. One is you have to have 500 hours or more of participation in your rental properties, or you have to have 100 hours, more than 100 hours, and more than anybody else. I don't want to go into the detail on that because there's a lot of fine points in there. But the bottom line is, if you can obtain the status of real estate professional status, getting those 750 hours, and then being able to qualify with material participation, now that loss that you show on your rental properties can now offset your W-2 income. Okay? So that can be very powerful, very, very powerful. But it has to be done right because this real estate professional status is under Code Section 469, which is all about passive activity. So I actually did get the buy-in from the husband. He said, yes. He said, I can do that. I'm willing to do that. And then, because they want to scale one property per year. And by the time I got off the phone with them, they were up to 3 properties a year.
Wow. Yeah.
So, talking about it. But yeah, so he was able to give that up. And how a quick back in the napkin story, how I showed him that I said, let's say that you purchased the property for $1 million. And of that $1 million, you can depreciate the building section of it. The land is not depreciable. So let's say that the land is $200,000, the building's $300 or $800,000. We can depreciate the $800,000, but there's a strategy called doing a cost segregation. I'm not going to go in it, but you do a cost segregation, which breaks the building down into its component parts. And then anything under 15 years, you can depreciate. It's called bonus depreciation. You can depreciate that all in the first year. So So about of that $800,000, typically 20 to 25% of that is going to be able to be written off. So let's say 20%, it's like 160,000, I think. They can reduce that $750,000 of her W-2 income. Now what they do is they take that savings, that tax savings, they utilize that, and then they purchase another property. That's how they scale. So, but there are a lot of things that can be done, and especially for high income earners such as physicians. But it has to be tailored to their unique situation and what they're able to do. But if you have buy-in from both, or even if it's a single person, if you have buy-in from them, there are ways to reduce the income, grow your wealth in real estate, and pay a lower tax than should be. And it's all done legally.
Yeah. And this sounds really interesting because, we're focusing on physician owners, but it sounds like if you have an associate in a medical practice who might be into the partnership route or maybe not, but is making a decent money, but is a W-2 employee of the practice, they technically could use this strategy you're talking about and, not necessarily open their own practice, but then still generate that additional wealth through this strategy you're talking about. Am I correct about that? Because it doesn't have to be just the physician owner. It could be any of the associates within the organization. So this really is a strategy that can help work with anybody that's out there just with a W-2 income.
Yep, that strategy, and there's a few other strategies out there that can work. I deal a lot with physicians, but I can tell you I have a lot of other clients that I deal with in real estate that are high earning income folks, like a CFO from a large company. I have one guy that on West Coast that's big into the Silicon Valley scene. So yeah, there's real estate can help you build your wealth long term and help you reduce taxes done the right way. And I always tell my investors, real estate is not a get rich quick thing. It's a get rich slow, but it is going to do what you need it to do over the long haul. If you think about it logically, and I always tell them, I said, look, God grants you a good life. Time is going to pass. Make that time work for you. Yeah. It's not about the because you know as well as I do, because you deal with physicians on a daily basis. They log a lot of hours.
Yes, they do.
A lot of the folks that I talk to in the physician, even though they're happy with their job, they want to know, can I leave my W-2 job early if I wanted to? And I said, yeah, it's absolutely possible because of the real estate. And, I always tell them, I say, it's not how much time you put in. It's what you put in the time. And done right, it's a very strong strategy. Now, as I mentioned before, I always caution them, I don't want you bucketing everything in real estate. I'm a firm believer that they have set up retirement plans. Mm-hmm. They set up a Roth IRA. They have their HSA going for them. And maybe if they have a side practice, doing a solo 401k. So real estate is my primary goal for these folks, but I also indicate to them, hey, this should only be a part of your portfolio.
Yeah, and that really is smart advice because they really need to understand that there are options. They just have to be smart about it. But I like your ideas as, to understand their business. I always tell them that it's really important, as in my realm and how I work with them. I always say you have to understand what's happening in your business on a daily basis. You have to have, the correct financial information to be able to make these decisions, because it all starts with good data. So, when I step into any business, regardless of whether they're physicians or not, you have a lot of times I find that they really are not, their data isn't correct. And this can hinder, in this conversation, see that people's credit might be affected by how they're running their business. And that's going to affect the ability for them to get these loans, because when they go for a loan, they're not just going to look at their personal side, they're going to look at their business side as well. So if they don't have their practice situated correctly with the correct financials, I have seen it time and time again, somebody will go in for working capital, whether it's for reinvestment in their practice or not, and they can't get it. And it's not because they're not necessarily making money, but their financials are such a mess. If the bank can't decipher what those financials are saying, they're not going to give them the loan, because they're going to say these people don't know what they're doing, A, and B, it really doesn't paint the picture that we need to see to make us feel comfortable to invest and give our money to these people. So part of what I try to help them do is clean up those financials so that the story is very clear, because nowadays, as you know, Bill, you send an application into a bank for a loan, it's not the underwriter is going to look at that information. It's a peon who doesn't even a lot of times understand what they're looking at. So if it's not easy for them to figure it out, they're going to pass on that loan. They're not going to move it forward for a review. So I always say to my clients, let's get your financials looking the way they need to look, so that there is absolutely no question what it is. A, the CPA has an easier time doing their taxes and giving them financial advice, which is what a CPA should be doing, rather than trying to do bookkeeping at the year-end rush because you got to get your taxes done. Really, I like to use financial statements on a regular basis for business management decisions. You can't decide when a good opportunity comes